Is this the next generation's 2008 crisis, or is this a trailer for the upcoming disaster? The question today we're going to ask is about the Great Unwind. Do you envisage, as I do, an absolutely catastrophic crash in the market? Why do I think that's happening? Well, there's a number of reasons, 5 or 6 of them, that are all incredibly compelling. The first is, as you'll know, we're entering a cycle of rate cutting, and we're doing it when companies' earnings are strong. They're still printing double-digit growth in earnings, and yet the Fed is cutting the cost of borrowing. So double-digit profits, but the central bank preemptively easing into strength. This is very rare. And the only precedent we've got is 40 years ago. It didn't end well. Equities were already very stretched. And that leads to a little bit of an air gap above the froth, right? Markets reach all-time highs. They go through a period of frothiness. There's a tiny little air gap before it hits the ceiling of that container and comes back down quite quickly. There's also a really strong concentration in the top 10 stocks. 38% of the S&P 500 is in just 10 tickers. That's record territory. It rhymes with 2000, not quite 2008, but you might remember Microsoft, Cisco, Intel, these sort of companies were really driving the S&P, and considerable weight was going towards them. That's what's happening now. You know, um, we're looking at a same story with such a small grouping of stocks, with such a large concentration of the money that's invested. So if those names start to wobble, the whole index is going to collapse. Obviously, that's two incredibly compelling reasons, and you put them side by side, you can't now ignore the possibility. There's also the fact that gross is going parabolic, right? The leverage and gross exposure from hedge funds is now at its absolute highest point in history. It would be in the 100th percentile across all time frames, across all significant time frames. So positioning is completely maxed out from the hedge funds, and a crowded trade becomes an exhausted trade. That is to say, as the smart chat pointed out on the Discord earlier, that when there's no one left to buy, buyers become exhausted. And that can cause rapid unwinds, which would mirror what we saw in 2008. And also, something I've been pointing out on the show quite a lot recently is this incredible streak that RSI has seen above the center line. It's very rare that you would see it above the center line for 100 days without even testing the center line. Rarer still that during that period you'd see approximately 50 of those days overbought. So that's why it is that all the 4 points above are also proven to be true. That 102 straight days we saw with the RSI above the center line only happened once before, anything similar to it, not even quite as extreme, and that was back in 2008. So is this 2008 all over again? There's lots of analogous points here: the concentration, the valuations, and then I would say the sentiment, though that's something we'll discuss more over the next few weeks, and hopefully you'll add a comment below and let me know your thoughts generally on the market. And when you ask around what do people think the next bullish stimulus will be, people talk about wars ending. Well, that's positive suggestion, but perhaps a little naive. And in and of itself, how does that necessarily lead to continuation of a current uptrend? That perhaps the sort of event you might look for a reset during. And then, it's just more of the same, right? What else could happen? Well, things could calm down in America, but that doesn't lead to competency with regards to institutions. So, long road to recovery there, I suspect. So, things look dangerous. There's an analogy to be had in that 2008 collapse. The systematic trigger then was leverage. A big problem was the housing bubble. We don't see that yet, but with the Fed easing into strength, new cracks will appear. So, is it 2008 all over again? Let me know in the comments. It's a sharp question. It's a worthy consideration. It could even be that we're going to go through something even more dangerous because, as I say, there's an awful lot of conflict going around the world at the minute. And only once before have we seen the Fed ease rates while corporate earnings are still growing in double-digit amounts. So this is something we've never seen before, right? Plus, alongside 40% of the S&P being in just 10 stocks, the market is very highly strung between two towers of fear and greed, and one of them's going to collapse, right? And it's going to take the other one down with it. So what do we think about that with regards to the charts? Well, we can come over and look at two of our favorite companies, if you like, and we'll start probably on SPY. Here is those charts. What is this time frame? 15 minutes extra, SPY, and we'll go up to the daily, stretch things out a little bit. This is the problem. If there is a drop in liquidity, then that's going to lead to a reduction in the buying power. It's going to particularly hit those 10 stocks hard. That's going to have an outsized effect on the entire index. And that's going to trigger a withdrawal of further liquidity, which increases the pace of this unwind, which is reflected in the chart in massive moves down. Here's the daily time frame, and get RSI on in particular. Looking at this aspect of it here, easier to see in the 2D. This extensive period above the center line, you stretch out, you can see quite what it looks like there. Take a measuring stick from currently to the last time it crossed the center line. You're looking at 51, 52 bars, right? So it's been a while. And then when was the last time you saw anything like that? You might think this is equivalent here. That's only 45. And again, what happened at that point in time? Right, we had a big correction. A big correction had previously just come close to that all-time high. So this is the sort of thing you'd be cautious of, generally speaking. And then when you put it in the context of such an extensive period, and it's not coming, isn't like it's going to have to be an immediate move of catastrophic losses to take this below the center line in the near term. So when it does happen, it will be violent, but does it look imminent? And you can go back here, and it doesn't take 2020 vision or me to stretch that out. You see that it's very rare that it would spend that much time above the center line generally, never mind not coming close to a test. I mean, here's another example we might think is reasonably close, and it's, when was that then? Back in 2000, ahead of this horrible move. So you see what I'm talking about with regards to these catastrophic moves, whether they're in 2008 and you get that terrible reduction, or it's pre the first disaster around 2000, the dot-com crash, that high concentration, the running on fumes, great gross exposure, leverage extremely high, hedge funds completely maxed out. There's no liquidity left to come into the system, and easing rates, that's going to make it the cost of borrowing lower, which is going to increase leverage in the system, which is going to cause this potential blow off top and disastrous return to a mean reversion. Now, I'm not calling for a crash. I'm saying that there hasn't been a test of support in an inordinate amount of time, so we can't be sure that it exists. Also, the distance to that short is so great that should prices make the move there, it will trigger such a withdrawal of liquidity to really cause an acute problem in the market. So it doesn't mean that even if support does exist, it's going to hold prices in the nature of the move that it'll take, that'll cause that meeting. So, this is the question we have to ask. How are you managing risk in this environment? Because moves to the top side still possible and significant. with an increase in leverage in the system. But with that leverage comes this return to the boom bust mechanism. And do you think prices are going to pull back down again then? These are all critical issues to be aware of. And we want to go and look at a particular chart to see a way out of it, because that's what we've been trying to create since the bubble started growing. A safe haven for people that are traders. Now let's look at a classic, right? GameStop. A lot of us grew up on this. So you're looking at prices have broken out of this accumulation formation, moved to the top side, come back and tested an important level of resistance. That's the right side of the head and shoulders that caused this return to test the mean. Prices broke up to the top side and then they've gone through a period of consolidation. In that consolidation, you have to ask yourself, is it accumulation or distribution? Well, it's mostly sideways price action. That's a little bit concerning. These peaks are starting to become divergence consecutively in divergence. So we're seeing building pressure here, problematic. And then this is a bearish butterfly, which could suggest prices coming back down again quite significantly. You know, the first target on this thing in at around $22. That takes it below the 2-day. Go down to the daily time frame, it is clear. It's a rocky outcrop flash, right? It takes below the 50 simple on the daily time frame down to significant level then of support. And if that doesn't hold, being the first target, rocky outcrop flash, it's active at the minute. They always hit. If you want that indicator, you get it at www.patreon.com/rockyoutcrop, where you'll also get the rocky outcrop toolkit. Incredible, right? Saves you loads of money in your TradingView subscription. Brilliant indicator. It's got everything you could possibly need in it, plus access to the paid side of Discord and Rocky and myself 24/7. So definitely check that out if you're watching this video and you're interested in improving your trading effectiveness. This indicator, absolute genius. Right, so the GameStop probably comes down test at 23.10. Does that hold? It's the 50 simple. That's below the 200 period moving average. So it could even break on the first pass and you'd be looking back at testing this area where we found support at $20. That's a significant level for GameStop. And if it does manage to break below those levels of support, it isn't divergent at the time, it'll come back and fill in this fair value gap. That fair value gap's also in around where you'd find target 4 of that butterfly. So there's a lot of concern there. Now, if it defeats that, prices will move to the top side and test in at around $38. And that's very positive. But are they going to do that as the market is collapsing? Probably not, right? Probably the follow the first scenario. And that's a critical concern for people who are using GameStop. Oh, I'm not even on the right camera. I'm on the, oh, am I? So, you know, the point here being that you're looking for a potential safe haven, a route, an arc, a safe trade that will mitigate against the potential collapse in the market. And GameStop would have been a lot of people's choice, whereas there's a lot of concerns for me at the minute with regards to that opportunity. So that's what I'm thinking with regards to that potential. We've tried to create this thing for people, safe haven for people, right? It's got the opposite on the go. So bullish harmonic. And that resonance coming in with price action, testing the low side of the RSI, bearish control zone, self opportunity for prices. If they're in a trend, they're at the low side of that trend. And you've got opportunities here. Maybe you're looking at the stochastics turn to the top side, crossing back above 20 there. As the RSI recovers, come back in towards the median line, you get a test up 86.96 LivePerson. And this thing could be starting a positive trend at that stage. From a macro low, you'd be getting the best possible entry. It's the easiest place to manage risk because it's closest to the historical lows. And if you were entering now, you'd be doing very, very well. Likely, also the fundamentals on it are shifting so that it's not exposed to a particularly dangerous debt position. But the question still remains, if the whole market collapses, how are you going to protect yourself? These sort of extremely risky, low market cap, penny stock trades do offer massive outsized topside moves. But managing your risk on these sort of things is critical, not just on the trade itself, but overall on your portfolio. How are you doing it in these current conditions? And obviously, NVIDIA is going to be one of these top 10 companies that if we see a critical toppling, it'll be one of the big guys to take a bit of a hit. And the daily time frame, you can see it's come up here, incredibly divergent, could easily put in a failure swing if it does push higher. It's got the stochastics exactly where you'd want to see it for a breakdown, and price action on a 50 simple not managing to move back above that important horizontal here that is touched a number of times around 185, 184. So does it push back above there? What's driving that? You know, is it speculation? or is it based on strong fundamental trends? Because if it isn't, if it's the former, not the latter, then you're going to see eventually a test of support, a reversion to the mean, the 200 period moving average, and then it coming in around 144. So these are important levels on NVIDIA. We've talked about it for a while. We said exceed the previous highs. This would likely be the resting point. And now the question becomes, is it going to turn over and fall back down again? So misfit, massive gap back down, closes that around 397. That speaks to a potential turning over on Microsoft. The previous highs in at around 466 means that this thing's going back down into the prior formation, and that speaks to the weakness in the move that we're seeing at the minute. If it is that prices on things like Microsoft and Nvidia are struggling, how do you expect those companies, which is their market only exists as a derivative of the existence of these big guys, how do we expect to see that moving? Because if Nvidia, Microsoft, so on, they're not seeing an expansion in market share, or at least addressable market through these new technologies, then that speaks to a tightening all the way down the ladder. And so you're looking for a narrative to emerge that suggests true bullish case, and that to be supported by recent tests of critical levels of support. And we're not seeing that in any of the top 10 companies. We're not seeing it on the index itself. We're not seeing it on any of these outliers. And it looks incredibly dangerous. So if you go to VIX, which we talk about relatively frequently here compared to typical market. You've got the downward sloping resistance there. Now, this come up and touched it like we suggested it would do. If that's to break, you're going to see a test of the 200 period moving average, the golden pocket, and then retracements against this move, all of which have been marked out there for you, which was absolutely staggering, massive moves. You can also trade UVXY itself, also with an incredibly, it's got rocket crop flash, it's got a extremely interesting harmonic on the go at the minute. And on the 4 hour time frame, there's an awful lot of obviousness, shall we call it that? Can we get away with saying that crap? Yeah, so downward sloping resistance, this thing, that breaks. It's very obvious where it's going to push to. 236, support moving averages, golden pockets, gaps, looking left. These are the sort of things that a lot of people, weekly 399, that is not something I'd be targeting on this particular type of chart, the way it's calculated, this particular index. You don't want to be trading flashes on weekly timeframes. But more about that on the Discord. If you're interested and have access, just ask me. A lot of different things on the go suggesting that we could see an increase in volatility, and put all of this into the context of where we are in the year. Well, I've talked about this last week as well, but you've heard the phrase sell in May and piss off. But actually, they come back. They don't piss off, right? They come back, and they come back around the end of September, the start of October. Liquidity enters the market, but that liquidity is the closing or unwinding of trades to start a new season, right? Now, this can be critical if you're seeing no new liquidity enter, trades unwind, volatility increase, and velocity moving, right? So big movements in price. So we're going to see a critical period throughout October for the stock market, which is going to go across rate cuts. It's going to be across important earnings. It's going to be with tightening liquidity, with the hedge funds back at their desks, but with all their money already invested, and to the point where we've never seen this before, and a concentration in some particular stocks, which all rely on the same narrative, right? Microsoft, Nvidia. So whether or not they're all buying each other's shares is kind of irrelevant. It's all the same addressable market. It's all the same opportunity. All of this happening when the world is under great stress, right? You probably feel that yourself. Awesome. Hit the like button. Let me know in the comments below. That's the whole point of this video.